right, I am back with another edition of the Sunday. Go ahead and check it out and be sure to let them know that I sent you. Now, let's time to get into the show. I got a very, very special guest here. He actually joined me in our Twitter Spaces, I think a week ago, and his name is Darin Tuttle. Darin, how you doing today?
Brandon, how's it going? Thanks for having me on here.
I'm doing great. Yeah. So you're out in sunny California, and I'm here in sunny Florida. So it seems like we got kind of the best of both worlds on opposite sides of the country, huh? Uh-oh, we got a little delay, or can you hear me?
Right. We're coast to coast right now.
Yeah, exactly. Coast to coast, coast to coast. All right. So, Darin, for those in the audience that might not necessarily know who you are or what you do, why don't you give me a little bit of background on, not only yourself, but your experience?
Yeah, no, sir. So for those of you that don't know me, I'm Darin Tuttle. I'm the Chief Investment Officer and founder of Tuttle Ventures. I am a portfolio manager and stumbled into this role after graduating with a business management degree from Brigham Young University, joining the likes of Goldman Sachs and Vanguard, and then shifting into a portfolio management role as a fiduciary registered investment advisor in Arizona, and then making the move out to California here about 4 years ago.
Nice, that's awesome. So you've stayed kind of on the west coast of or west side of the United States, which is awesome. So let's bring it back a little bit. We kind of talked about this a little bit pre-show, and I've heard you and a couple other podcast interviews. But you were a collegiate athlete, is that correct?
That's right. That's right. I was like Rudy. If you ever seen that movie Rudy, I walked on, played college football. I was a tight end, so I could catch and I could block a little bit.
There you go. That's awesome. Yeah. So, I mentioned it before. And for those that have been following me, kind of probably know that I ran track at the University of Memphis. So we both kind of have that connection there. It takes a special kind of mindset and dedication to get to the Division I level. And so good on you for that. So, I guess bringing it into sports and bringing it in. So how do you think that, that journey, being a college athlete and, training years on years on years and just dedicating a lot of time and effort to it. How do you think that that's affected you today and kind of like help, shape your mindset to where you are?
I think there's a lot of similarities or crossovers with playing collegiate sports and then investing or financing, your future. And essentially it just comes down to dedication, practice, self-discipline, right? So with being a college athlete, you have to be self-disciplined in a very highly competitive environment, right? And with investing, it's the same way. You can't, rein yourself in self-discipline wise by, working harder on your body, but rather it's more of, working harder with your mind, your process, having that long-term focus. So there's just a ton of crossover that happens between the two.
Yeah, I think a lot of people underestimate the overall mindset and just like mental toughness that it takes to do all these sports. A lot of these people see, just these freak athletes go out there on the field and just go and excel. And at the end of the day, you just kind of have to just watch them go because they're just athletically built a lot better than, the average person. And they're built more so for that sport than the everyday person. But, at least for myself, I always felt like, I always had to work that extra step and be a little bit more mentally tough and kind of go through the ringer that way to kind of help me catch up to maybe those guys that are a little bit more athletically gifted. And I don't want to speak for you, but did you kind of, I guess along those lines feel that way as well?
Oh, no, absolutely. I mean, I played with a lot of collegiate athletes that are now still playing in the NFL, right? And when, I initially came on, I was a freshman, but I was looking at, seniors And so there was like a 4-year gap there, and thousands of hours of practice in between. And so, I think having that long-term perspective, right, makes all the difference. And, by the time that you're a freshman, by the time that you get to a senior, right, that you're able to kind of have that long-term focus and look back at how much you have achieved over that time frame.
Yeah, I think football is one of those interesting sports too, where it's like, especially in college, unless you're some freak athlete or coming in these 5-star recruits, generally speaking, you don't really get too much playing time until you get a little bit later. A lot of freshmen maybe redshirt or anything like that. So, it's not until your third, fourth, maybe even fifth year till you're kind of significantly seeing the field a lot too. So, I definitely want to hammer home that long term thinking here, especially in kind of the day to day swings that we're seeing in the market today, and the earlier this week as we're recording here. But let's kind of keep it back to your your experience and kind of your upbringing. How did you kind of get started in this realm of investing? Did you get first kind of hear about it in college, or was it more so, maybe parental influence or something along those lines?
I would say that I'm just like a naturally curious person. So when I was little, I always wanted to find out like who invented something, right? I'd be like, who invented the bike? And my parents were like, I have no idea, right? But I always wanted to know like who was the person behind something. And when I started studying finance in college, there's just so much that you see like on TV and in the movies of what finance is like. But I was just like really curious about like what that average life would be like. My dad and my brother are both dentists, so something totally different. And so they kind of relied on me to say like, hey, what is happening like with the news right now, or like what's happening today. And I was just a naturally curious person and wanted to find that out. And that's really kind of what led me into finance initially.
I gotcha. And so from there, you just kind of like through studying it and taking deeper dives into companies and just that overall curiosity. Do you think that's kind of just like kind of help you naturally just get to where you are? Is just that underlying something that you got in you?
Yeah, no, I think my big break really came, when I had my first internship at Goldman Sachs. And I didn't have like a really glamorous position, right? I wasn't in investment banking or private equity, right? I was in operations. And so operations, you're really viewed as like a risk manager or a risk mitigator for all the functions that the bank has to provide on a day-to-day basis. And with that opportunity, I just decided, to own it. And even though it wasn't the most glamorous, I tried to make it the best where I was in that current moment. And so what I found is that my success over the careers has kind of been this way of running to the problems or running to the fires and being willing to step up and help those, even though they may not be the most glamorous roles initially, because you gain a lot of experience and you become irreplaceable, right, for where you're working at. And so that was my whole mindset was, hey, I'm going to do the things that nobody else wants to do. In doing that, I'm going to gain skills that nobody else is going to have. And that's going to make me valuable and have life experiences going on, ultimately when I'm doing something that maybe I enjoy more or is more aligned with my, best skill set.
Yeah, it kind of brings me back to the sports analogy here. You got to make sure you do the little things right. That maybe not the most glamorous things, especially in football. Playing tight end or it's one of these other skill positions. You see the touchdowns, and that's what you kind of think of. But maybe it's the blocking or running the right routes or helping somebody else get open that really can change the course of the game and help your team and help you win. And at the end of the day, that those things aren't necessarily shown up on the stat sheet, but it kind of makes you, like you said, irreplaceable and helps you down the line. So,
Oh
yeah,
no,
so I think
no, absolutely, absolutely. Like if you're a tight end and you can't block, right? Then you're really just like a glorified wide receiver. In finance, like for us now with our firm Tuttle Ventures, right? We analyze hundreds of different companies, right? But not all of them fit into the portfolio. So a lot of them are just coming up to bat, seeing the pitches that are coming down the line, right? Lots of different screens, lots of different tickers, lots of different ideas, lots of different models, lots of different analysis, but then not all of those show up on the scoreboard, right? And so we run a concentrated basket now of high conviction equities and non-correlated assets to the overall market. And so what you see that ultimately lands in the portfolio is, our best ideas. But to get to our best ideas, we probably had at least 100 strikeouts to be able to get to that best idea portfolio that you're looking at today.
Yeah, it takes a lot of, it seems like my time in investing, it takes a lot of just learning from your mistakes, or learning from a lot of other people in the industry, and kind of picking the brains of very smart minds in there, and that have been doing it for a while. But I think, during a time like this where, we're recording here on Wednesday, May 11th, about midday, we had a big drop on Monday the 9th. Overall in the market, and then we kind of saw it like a little bit even, but we're seeing a massive amount of volatility going on right now in the stock market, in almost every sector. So how are you kind of like looking at and dealing with this massive amount of volatility, and is it kind of changed anything that you're doing so far, or change any philosophy that you have as far as your investing strategy?
Well, Brandon, I'll say it does make you have a little bit of a gut check, right? When you're looking at this fear and greed index that we call the VIX, right? Where we're looking at it at extreme fear levels right now. If we're looking at stock price strength on a broad market index basis, right? We're at the lows of the lows, where we're having a lot more companies reporting this lack of conviction in a better future going forward. What I would say is that we've been preparing for a moment like this from a macroeconomic standpoint. In our portfolio, we're buying really boring companies with high levels of free cash flow, and have been allocating to those positions since around October of last year. We saw some of the writing on the wall in terms of stagflation and an energy run up and a commodity super cycle. And so, the trades that we've been having on since the beginning of this year have done pretty well. The peak for the portfolio, we were up 19%. This was across, commodities, primarily energy allocations, and then also just bellwether boring companies that are generating high levels of free cash flow. And because of that, we've been able to weather the storm somewhat, right? I think ultimately when you're investing something that's somewhat contrarian to the overall market view, things can look a little bit different. But then at the same time, I don't have to make a judgment on where the entire market is going. I just have to make judgments on, that basket of equities that we hold.
Yeah, exactly. So is this kind of, I guess, when you have your clients on the phone and everything like that, I feel like this is a time you don't really envy the investment people, because I'm sure you're getting a lot of phone calls, and people may be worried about it. So how do you kind of, I guess, help the average person, or maybe your clients, or somewhat, kind of zoom out and help weather their maybe their fears, or overall just their worries about the market crashing and everything like that, and kind of if they're seeing these major news headlines, or seeing the Dow crashing and other things like that.
Yeah, I mean, It's not easy being an investor, right? And you have to be able to um, have that self-discipline and also know yourself pretty well, right? Um, I would say if somebody's really worried about the market, that panic usually breeds more panic, right? So if you follow the herd and everybody's panicking, before you know it, you're going to start panicking too. So really focus on the voices that you're listening to. If you're listening to a lot of negativity, a lot of panic, it's just a matter of time before you start to panic as well. I think the second thing is if you don't really know what you own, for me at least, I'm the type of person where if I don't know what I own and it's starting to go down, then I'm like, why am I even holding this? I start asking a lot of questions, right? Because I'm naturally curious. If you have a relationship with an advisor, or if this is a portfolio that you bought for yourself, you should know what you're buying before you buy, right? So it's like a measure twice, cut once kind of rule. And so for me, when I'm managing risk, we have estimations on how much the market could go down or how much our portfolio could go down on any given day, and we create expectations on both the downside and the upside to be able to do that. And they say that mostly losses hurt twice as bad as gains do, right? So making $10 on the upside is about the equivalent of losing $5 on the downside. And if you don't have that kind of forethought of saying, hey, I could lose 5 on the downside to be able to make 10 on the upside, then when you do start losing money, you're going to be a little skittish and you're probably going to want to sell out.
Gotcha. So really having those, conviction on, why you're investing in companies. I think that's, it's what has helped me as well. Because, when you're buying something, whether it's, going down or up, the next day, it's easy to kind of have that initial reaction where you're like, all right, I made the right or the wrong decision very shortly. But, I guess if you believe in the long-term vision and the company and the products and everything about the company, overall, it eventually the company will become more valuable if your beliefs are correct. So I think that's an extreme.
Yeah, I think you make a really good point, and I also think time is a big saver as well, right? So if I put a bunch of money into the market and the next month it drops 30%, right? I'm gonna have a pit in my stomach and I'm gonna be feeling bad because I hate losing money, right? But if you've been able to weather the storm, to see the market rebound through some of its previous sell-offs through history, and zoom out a little bit, you can feel better there. And then the second is thinking in probabilistic terms. And what I mean by that is there was a company that we were analyzing before I started Tuttle Ventures called the New Home Company. This was a home builder, a really small cap home builder based out of Southern California in Irvine here. And the stock was very volatile, but it was also trading about half of its price to book, right? So price to book is financial measure, looks at everything that the company's putting on their balance sheet, right? Their books, and saying what that's worth. And then it's taking the stock price and it's comparing that to what's on their books. And they were trading at about half of that level. Well, the reason that they were trading at that level was this home builder was pre-selling homes. They were selling homes, collecting that initial deposit with the obligation to deliver that home in the future. And so after doing that research, which probably took a couple of weeks to be able to figure out that fundamental reason why they were trading at such a deep discounted valuation, we were able to make a probabilistic estimate, or for lack of a better word, a bet on what we think the future of that company's value is going to be. And our thought was that homes were still going to be in demand, that they were going to have strong management that was able to fulfill that demand that they've already pre-sold. And we thought, hey, in the future, this company is going to be worth more. And so, later on down the road, New Home Company actually got bought out, taken private for about $14 a share when our initial, buy-in on the stock was around $3. And so, that's a big win story. Those don't always happen, but when you use that kind of way to analyze a company, initiate a position, have a probabilistic outcome way of thinking about what the upside potential is, then it creates some solace when you see 5 or 10% price fluctuations on any given day.
Yeah, and I think we're seeing a lot of price fluctuations that are almost out of the control of the overall or underlying business at this point. I think we recently had the Fed raise interest rates by 50 basis points, and then today, actually earlier this morning, we announced the Fed announced the CPI print for the month of April, when it came out to about 8.3%, which was above expectations. So I think that the market kind of reacts a lot to these necessarily some of these metrics. But as far as I guess CPI goes, are you one that kind of is somewhat of a believer, or do you kind of track these CPI prints, or kind of hold any weight towards this, or are you just kind of looking at, as you said, very long term? So in the short term, the CPI isn't as important.
Oh no, this is no, Brandon. This is very important. I think the first thing is your comment on interest rates, right? So interest rates are the gravity around all financial markets. So as interest rates rise, the price of money increases, right? So you need to make sure that you're allocating your capital efficiently, right? If you have a tighter budget, you're going to be questioning, hey, is that purchase really worth it? Or, can I do without? So that's kind of the first thing is interest rates really do matter. And rising interest rates are typically done to maintain price stability, right? And maintain full employment. And so CPI has a really big impact. The CPI that we're seeing now, we could kind of have seen that coming with just the flush of free money from the Fed monetary policy. And for us, what we like companies similar to what succeeded back in the 1970s, right? So I took the period of the 1970s and said, okay, what was working in the 1970s when we had inflation at these levels back then, and they were hiking into a recession, right? The companies that worked well then were energy and also companies that had these verticals, right? This was really popular back in the 1970s, was these vertical cost structures of companies to be able to own a process from start to finish. And so if you think about a vertically integrated company, you can use, for example, a lemonade stand. A lemonade stand, if you're vertically integrated, you're not going and buying the lemons from the store and then buying the pitcher from the store, and then that's how you come up with your materials to have your lemonade stand. If you're vertically integrated, you have the lemonade trees or the lemon trees at your house already, right? And you're picking the lemons from your own tree, and you're using a pitcher that you have within your own house. And so you're able to have lower costs because you're delivering things from the ground all the way to selling that cup of lemonade. And when you can control more of the cost with a vertically integrated corporate structure, rather than this like really broad, wide, global outsourced structure or horizontal structure, you're able to control a lot more of those costs during an inflationary environment. So those are things we like within companies that we invest.
I gotcha, and that makes sense. So when it comes to energy, I guess the overall CPI print is kind of at just that one number, right? The 8.3%. But they also publish, a little bit deeper of a breakdown. So, just reading off some of these numbers that they have from year over year, they go, into food, energy, commodities, used cars, all that kind of things. But, if you really look into the energy sector, energy's up 30%, just overall energy commodities up 44.7%, gasoline up 43.6, fuel and oil up 80%. So it seems like, a lot of these energy services are up, drastically compared to last year, not just that 8.3 number. So I guess this is kind of like a two-part question is, how much weight do you hold into that one CPI number? And when you're looking at, more so of these energy companies, do you take into account, how much that they're reporting it's going up, or do you kind of like seeing that, these energy companies are, everything's getting kind of more expensive because in the end of the day, that means, more profit for these energy companies that you'd be investing in?
Well, kind of two parts. Sorry, I didn't hear the full question there. But I would say that the first point, right, is that we need to remember when oil went negative, right? And when oil companies were down 60%, this wasn't too long ago. This was about 2 years ago. There was that supply and demand imbalance for a commodity that's used by most Americans every day if you're driving in a car, right? And so the lack of investment in energy has led to imbalances with significant price increases on top of this environment where we're just flooding the market with free money. So we had a lack of initial investment to commit to these energy providers that have been doing this for the past 150 years. So that's kind of the first point. And then I'd say the second point related, with energy is that going forward, I think we need to be able to recognize that we can't have, these guardrails in place that stifle innovation or stifle the capital that is flowing to reduce costs. Because if you do that, it just exacerbates the problem, right? Let's come to the table. The U.S. is now a net exporter of oil, right? And we've worked hard since the 1970s to be able to do that. And now with the price of oil going up, as a net exporter of oil, the U.S. should be in a better position it was now than back in the 1970s when we were having, lines of cars and you could only get your gas, on certain days of the week based on your license plate number.
Gotcha. Well, that all makes sense too. We're kind of talking a little bit more of the overall macro environment, and then kind of diving in a little bit into the underlying businesses. And that kind of brings me to another question I have for you. So, three aces at Not a Big Deal 111. I co-host my Twitter Spaces every Tuesday with him. He's been hammering ever since I run into him about the 6 stages of the business cycle. So for those who aren't familiar, it's the first stage is kind of seeing bonds decrease. And then, we're kind of in stage 2 is more so of a recovery. You see the recession start to hit, stocks are going down. And then stage 3, commodities start to turn up. And then stage 4, bonds start to turn down again. And then stage 5, stocks, although they're kind of reaching their peak and turning down. And then the last stage, you see the commodities start to turn down. So do you, take a dive into where you think we are in the overall business cycle, as well as kind of looking a little bit deeper into the macro when you're analyzing a lot of these companies?
Yeah, Brandon, I'm not familiar with that cycle you mentioned in particular. But what we always do is we're always trying to think about where things are going to be not right now, but where things could be 6 months from now. And so, as an investor, we're investing for the future. I don't get paid, to make money on day trading, right? I'm not looking at minute to minute charts. And so, because of that, understanding, where we are now on a map. If you think about a map, right, and you say, most maps will say, okay, you are here, and they got a big star around it. And then there's an area that you want to go to in the future. A lot of people in the macroeconomic environment argue about where we are right here, right? They spend all this time, all this energy saying, no, we're here now because this is what bonds are doing, or no, we're here now because this is what energy is doing. For me, I'm trying to think, okay, let's take the information that we have now and let's extrapolate it out 6 months into the future. Do you think 6 months from now, energy is going to be energy demand is still going to be present, and there could be some supply and demand imbalances as companies plan out their forecasting for the future? Certainly, right? In terms of bonds, do you think people 6 months from now are going to just forget about the double digit decline that they've had in bonds, and not really view it as a safe haven going forward? Probably not, right? And because of that, over that landscape of time of saying, okay, we could be here, we could be there, we could be there, but where are we going forward? And that's where, as you look at a comparative time frame in the 1970s, how did they emerge out of that period of the 1970s to the prosperity in the 80s, the 90s, and the 2000s? Well, there was a revolution in energy, and there was a change in the banking system, right? Removing the gold standard. Those were two critical events that happened over that time frame for them to be able to move from we are here into a prosperous future.
Exactly. Yeah, that all makes sense. And yeah, I mean, I totally, agree with your point about, zooming out, and we do kind of analyze where we are, at the minute. At least a lot of times I'm still trying to figure out, where we are, to kind of help, I guess, forecast where things are going to go. But, like you said, I think that having the longer term outlook definitely has helped me in a time like this where it seems like everything's just going up and down by the day. Um, but yeah, previously I've heard you in a another podcast. I believe it was the What the Finance podcast, where you kind of went into three sectors that you saw, kind of succeeding. So I don't know if you remember those three sectors exactly, but I kind of wanted to get into your thoughts on maybe the cybersecurity sector and how you kind of see where that's going, and if you still I think that podcast was maybe in 2011, so maybe about a year ago. But if you're still kind of bullish on that sector, and if you think the digital age is still kind of moving forward.
Oh no, absolutely. I think cybersecurity is of utmost importance across the board, and it has real world impact now as managers are in the boardroom talking about, how can we protect our data, and how can we protect our employees in a work from home environment. So we've been obsessed with cybersecurity as of late for the last couple of months. It's very hard to price these correctly. I've talked on the public and private side with different companies that are doing a lot of different innovative things. Most companies that want to protect for cybersecurity want to just write one check, give it to some well-deserving a service provider, and then call it a day, right? But things aren't really structured like that. The way that cybersecurity is set up now is you can get attacked from so many different angles that it really has to be embedded in your company culture and company structure. And what I mean by that is the companies that have these, one-time cybersecurity solutions can usually just be viewed as like a cost to the business and have a limited or finite value that they have in the long run. But think about the companies that are revolutionizing the infrastructure of cybersecurity that I think would be embedded in all aspects of the business model. So when you think about Internet of Things, who's doing cybersecurity related to the Internet of Things, and how can that be embedded with every aspect of a business's day-to-day operations is where I think the most money can be made going forward. And we like investing with companies that have high potential upside.
Yeah, that's great. And yeah, I mean, you definitely want to find those ones with the most upside for sure. So how do you go about finding these said companies? Do you more so look at sectors first and kind of think like I said, brought up cybersecurity is a big sector that you guys are focusing on. Do you go from cybersecurity and then look into companies doing some good things and some encouraging things, or do you more so I guess cast a little bit of a wider net and just look at more so broader companies that you think might be successful based on various factors, whether it's financials or CEOs or other things like that?
Yeah, so for us, we take a look at it from a geopolitical lens. So I'm a big fan of George Friedman. He's wrote a couple of books related to geopolitics and what that means in relation to different companies and different countries, how they interact, and what that implies for their profits going forward. So we take a geopolitical lens and say, okay, where are the biggest risks out there in the world right now? And so we take a playbook out of George Friedman to be able to form kind of that picture, right? And then the second is we take a playbook out of Joshua Steinman. So I don't know if you're familiar with him, but he was the National Securities Advisor for cybersecurity under President Trump. And he's working on some cybersecurity aspects on the private side related to infrastructure. And so the merging of those two, a geopolitical perspective, and then talking to people that are way smarter than me that have been doing this for a really long time and relying on their expertise kind of help build this thesis for us going forward. So I'll give you a concrete example because I'm talking in very big abstracts. But there's a company we really like called Maxar Technologies. And, you can do your own research on the company, but essentially it's a satellite company that's has contracts with the US government, but also sells to commercial providers as well that are able to take, views from space anywhere in the world at very high resolutions and connect that data to what you need for your business. And they got a lot of free publicity during the war in Ukraine when all of their satellite images were plastered all over CNN and the like. But that's, a fully integrated cybersecurity company, in my view, as wars and as conflicts demand, a new evolution of war going forward that also includes space. And so that's one of the names that we hold in our portfolio. So that makes me a little bit biased, but that kind of maybe gives you a little bit better concrete example of what I mean when I'm talking about this lens that we're viewing cybersecurity from in terms of geopolitics and also infrastructure.
Gotcha. Now, maybe for a little bit of a tougher question. So, I think it's easy when you get these companies to kind of, more so fall in love with them, figure out, what you really like about it. But how do you determine when your thesis has changed on a company, maybe to necessarily get out of a position or get out of a full sector? So, whether something happens or, something changes quickly, how do you kind of go about that I guess, mental exercise to constantly, go through and evaluate your thesis.
Yeah. So going back to Maxer for a second. So all of our portfolio companies, we've identified like the biggest risks that could be applied to those companies, and then we estimate the probabilities of those happening, right? And we say, okay, if these happen, then we're more likely to sell because this will impact future earnings or long-term earnings. For example, one of those with Maxar Technologies, the satellite company, a big question that we had is whether they're going to delay their next worldwide Legion satellite launch, right? So they had this launch that was planned in 2021, then it got pushed to early May of 2022 or spring of 2022. And now they're saying that they're pushing it now to the fall of 2022 before they put these new satellites up. And so we knew that that was a risk going into buying into the company. And we estimate that pushing that launch date is going to add another 50 million in costs to their balance sheet, right? And so this is all like really fundamental stuff. I'm at heart a fundamental guy. I'm a CFA, a chartered financial analyst. I love dealing into the financials of these companies. And what we saw was, okay, they're going to take another $50 million hit on their bottom line. But then they also have over $1 billion in backfilled orders for satellite data from various different companies. And so they still have like a long list of potential customers that they can fulfill if they execute well. And we believe that management has the track record and also the capability to be able to do that. And so even though we had that bad news happen that we had modeled out, we kind of know the downside risks of it. And then we're taking this educated guess that we think in the future, things for this company are going to be better than they are right now.
Gotcha. So it seems like you kind of look at more of financials and maybe some metrics too, and take a dive into the numbers, but also taking into account some of the fundamentals and just the underlying business and the products and services that each company offers before.
I know, Brandon. I wish I had like a magic wand, and I could say if you just did these three things, you'd never pick a losing company, right? But I've worked really hard in establishing, a process of way of being able to look at these companies, being very disciplined, learning from some of the best in the industry, and just and studying a lot. And that doesn't mean that I'm immune of making bad choices as well. But for me, I'd rather make a bad choice and know why I made that bad choice and understand that, hey, this time the odds just didn't work in my favor, rather than, relying on somebody else and just taking, a random guess. And if it doesn't work out, not really knowing why. And so that curiosity and wanting to understand how things work and how they come together is really what really motivates me going forward with managing investment portfolios.
Yeah, I think at the end of the day, whether no matter how you analyze it, you're gonna pick winners and losers. When the market's gonna maybe not make sense at all times, and maybe it will at other times, and you just make a bad choice. So I think the biggest point that I'm taking away from what you're saying there is, at the end of the day, learning from your mistakes is the biggest lesson that you could have. You kind of going back and learning why maybe necessarily company X was a loser, so to speak, or it didn't work out as well as company Y, where you were kind of picking between the two, and just taking a step back and learning and recognizing this is why company Y was more successful than company X. And at the end of the day, it's all to make yourself a better investor. And I think that's my biggest takeaway. You can talk about the different ways maybe to invest and whatnot, and kind of analyze companies. And I think everybody's got their own kind of cup of tea for it. And yeah, I think overall, it sounds like your strategy has been doing well for you guys so far. And yeah, so congratulations, one, on the success, and thanks for taking a dive into how you really dive into these companies and analyze them.
Absolutely, Brandon. And I really appreciate, having the time here. I think what you're doing now, talking to people, learning for yourself, setting up these spaces, right? Like that's a big feather in your cap, right? Seeking to understand and knowing, where things are going is a difficult task, right? So nobody's perfect, and things have worked out now, and we're excited about the company's future here at Tuttle Ventures. If you're not already subscribed to the newsletter, that's where I'll put most of these big brain dumps with actionable market insights for you to be able to cut through the noise. So Tuttle Ventures newsletter, if you want to check out more.
Okay, yeah, awesome. Yeah, I'll definitely do that for sure. And then one last question before I let you go. So we obviously met in a Twitter space, and you have a pretty good following on your Twitter. So feel free to plug your handle here before you get into it. But how do you view financial Twitter in the spread of ideas? And then I'll ask you one follow-up question after you kind of answer that one.
Oh yeah, no. So I'm a registered investment advisor in the state of California, right? So I have compliance measures that I have to navigate through on social media to be able to make sure that I'm not, guaranteeing returns or not giving a fair and balanced approach and not making blanket recommendations for people, right? But there's a lot of good in social media and there's a lot of bad. I have found so much good from Twitter. I've been on there for at least 11 years. I've been talking about, these esoteric financial matters on Twitter for a long time. They're only now starting to get popular, which is great. Pre-COVID, we would have these quote unquote FinTwit meetups where it was probably, 10 to 20 just characters from Twitter that would come together and meet. And from there, I was able to meet with a lot of people that I wouldn't have access to had I not otherwise been on Twitter. And so for me, as somebody that's passionate about finance, that somebody that's in the industry, and then somebody that has to navigate it from a professional standpoint, I take Twitter to be a fun place and a place where I learn a lot and something that connects people from all over the world. So I love it, and happy to be able to have that chance to talk to people from anywhere, pretty much about anything. So I'm excited about the future of Twitter and glad that it's been rewarding for me in my business.
Yeah, that's awesome. That's great to hear. So, one thing that I really like about Twitter and FinTwit is just like you're saying, there's a lot of spread of ideas and the ability to learn a lot of stuff. So, how do you, I guess, filter through a lot of the things that you hear on Twitter, whether it's Twitter Spaces or Threads or things like that, to determine if it's maybe good information or if the thesis on a company is something that you agree with. So how do you how have you kind of created your own personal filter on like good and bad information?
Yeah, that's a good question. I have lists that I keep track of. So I have lists of like different experts or niche experts in different areas. So I've really kind of narrowed down who I listen to for something specifically based on lists. I'm a big proponent of that. The second is, I have like these filters that I use, my search filters. There's a big thread I did on it, how you can kind of control who you're viewing from your timeline, which has been huge for me. And then, I think the other point is just to realize that Twitter is such a small sample size of the overall population, right? That maybe there's a lot of idea generation from Twitter, but there's still a whole host of market participants and just regular people, right, that aren't on Twitter. And so you have to be able to balance what people are saying on Twitter with what's actually happening in the real world. And if those two aren't really aligning, that's like my first kind of call on how to sniff out BS. The second is I can rely on, a research team and analysts to be able to take maybe an idea and see if it has merit, and to be able to run and test it through. And then just the fact that I've been on the platform for so long, I've met some, a lot of these people in person, or I've talked to them in DMs and then started talking to them, over the phone and things. And so develop a relationship of kind of who you should talk to and for the right information, and who you shouldn't talk to. And I think that just takes time.
Gotcha. Well, Darin, thank you so much for your time. I really appreciate it. I think the audience is going to really love this one as well. So why don't you tell everybody where they can find you, maybe how they can contact you for maybe some investment stuff or whatnot. So yeah, go ahead and plug all your stuff.
Yeah, for sure. I mean, I already plugged the newsletter, right? And then I'm on Twitter at Darin, DARIN _T80. So Darin T80. And then you can always visit my website, www.tuttleventures.com. On there, post some of the research, and also you can take a look at the firm. So
awesome stuff. Well, everybody, you should go check him out and give him a follow on Twitter. Darin, thank you so much for your time today. As know, it's very valuable. And yeah, have a great rest of your week.
All right, for sure, Brandon. Hey, appreciate the time.
All right.